Hey, what's up, everyone? My name is Ali. Welcome back to my world of stocks, and welcome back to my three stocks on sale series for the month of August 2024, where in each episode I pick three new stocks that I feel look attractive at today's prices for the long term. Now, this month will be a bit of a special episode, though, in that I specifically chose three stocks that are now trading right near decade lows, which I feel makes some very compelling options for investing. And these are stocks that are heavily beaten down, have crashed by huge amounts, and are at very low levels. Now, as always, I'm still going to group these stocks into lower risk, medium risk, and higher risk options. But the more prominent feature, again, this month will be that they are trading near decade lows. Of course, please remember though to always do your own research and make your own decisions, especially today will be a bit higher risk for all categories. And everything that we discuss today is, of course, just my opinion. I'm just showing you what's out there, what I like, if I'm looking for some discounted deals. Okay, I can't wait to share these picks with you. So let's go ahead and just jump straight into this. And let's start with first a relatively lower risk option, which is not going to be easy to find one of these at also a decade low. But I do feel that Disney, ticker symbol DIS, might fit the bill here as probably the most obvious choice that we could look to, as they've not only fallen close to 20% in the past 3 months, but they've lost now over half of their entire value from the top, leaving them at also one of the lowest prices of the past decade. And that's pretty wild for what is arguably the biggest media and entertainment giant in the world. Now, there are, of course, several reasons for why the stock has fallen by so much, including rising competition in streaming, along with heavy losses from all the investment into that. There was also the pandemic that closed theme parks and resulted in less movie theater traffic, something that continues to this day as people just generally don't go out to movie theaters as often anymore, which, by the way, that also took a toll from the writer's strike that delayed things even further for new movies and shows. And at the same time, many of those new movies and shows have actually received customer backlash for not being as high quality, which is especially the case in Marvel and Star Wars. At least for me personally, I'm a big Marvel and Star Wars fan. And yeah, I haven't really liked what's been coming out from them lately. For example, The Marvels was literally the worst performing Marvel movie of all time, while the new Acolyte Star Wars show on Disney Plus has a terrible 17% audience score on Rotten Tomatoes. But my argument in favor of Disney stock, I guess, putting those issues aside, well, not necessarily putting them aside, but the fact that we're just not going to really be able to get a deal like this for a powerhouse company like Disney trading at a decade low if it didn't have some of those serious issues. And so my investment thesis is to buy the stock now while it is down in hopes of a rebound recovery, which at these prices I do think is possible. And here's why. First of all, the stock is trading 22% lower than the sector on a PEG basis and over 67% lower than their own 5-year average. That is dirt cheap for what is still a box office leader with also by far the most theme park attendance, 9 out of the top 12 in the entire world. And it's also about tied with Amazon and Netflix as the largest subscription video streaming platform now too. And while content has been severely lacking, you don't have to tell me, I've been a big critic myself, but we have had a couple of new moves that are leaving me feeling a little more optimistic than I have been recently about their future. Notably, the new Deadpool movie that not only became one of the best-selling Marvel movies of all time upon release, but it's also shattered records for having the best opening weekend of any R-rated movie ever at close to double the amount of the previous record holder, which, oh, by the way, was actually another Deadpool movie too. And I think this momentum may continue into the coming years, as we just saw in Comic-Con that Robert Downey Jr. will be coming back to the MCU as the next Doctor Doom, and that's pretty freaking cool. Now, I know that there are many people out there saying that this is kind of a cheap way of Disney, kind of getting themselves out of the hole by just bringing back older actors and characters that everyone loved, but I couldn't care less. I think that if it sells, go ahead and do it. And I'm a fan of it. I want this is actually, I think that they used to have much higher quality. The storytelling was way better. back in the older movies and stuff that they used to do with Marvel and Star Wars. So if you start to bring some of that back, I think it's a good thing. So I'm all for it. And look, hopefully they just give the audience more of what they really want moving forward. And that's what I'm hoping for. Now, in the meantime, though, I just think the stock is too cheap to ignore. And I continue to buy it at these levels. Anywhere really less than $100, I think, is a great price for Disney stock long term. And especially, 90 or below that, I think it's even more attractive. Okay, moving on to stock number 2, though. Well, we're going to be increasing the risk a little bit for the medium risk option here, but we're also, again, staying near a decade low price. And for this one, I'm going to go with the telecom giant Verizon, ticker symbol VZ, who has now seen their stock price fall by over 20% in the past 10 years, while also being down about 35% from the very top. And look, normally I wouldn't consider Verizon to be all that risky, as they do operate in a pretty stable, basically cash cow type of market in telecom that isn't likely to go away anytime soon, as the number of people using smartphones and internet continues to grow around the world every day, and is not only the number one market share leader of wireless at close to 40% of the US market, but also the largest quality awards winner at over 3 decades in a row, nobody even coming close to that. I just think Verizon is unmatched by any rival, with even their two biggest in AT&T and T-Mobile essentially just making up the rest of a triopoly market that isn't likely to get broken apart anytime soon either, given how much money they've had to spend in building up the largest infrastructure and communication technologies imaginable that aren't easy to duplicate. I mean, we're essentially talking about here hundreds of billions of dollars being invested into these things, maybe even trillions if we go back to the inception of these companies. So that's just not going to be an easy market to break into now if you're a newer competitor. However, that's also where the risk comes in because of all of that enormous spending, especially recently in areas of 5G and fiber, which, along with some other mistakes and failed business ventures that have left these companies with massive debt. I mean, a great example I often point to is AT&T, their acquisition history of like DirecTV and Time Warner, just leaving them with so much massive debt. But Verizon is no different. They currently hold over $137 billion of long-term debt, which is absolutely massive, especially given our high interest rate environment. And that makes servicing all of that debt even more expensive. Now, that has at least been coming down a little these past couple years. So you can see that they are at least starting to make some progress on it, coming off of the huge 5G investments. But at these levels, it's still a very concerning amount that could lead to less cash for them to be able to invest back into R&D or to pay out their mouth-watering dividend, which is really the most attractive feature of a stock like this, since you're not going to really get much growth out of a company like this. Instead, you're really just taking it for the value and the income. But Verizon absolutely has that, as the dividend now yields well over 6.5%, one of the highest levels in their entire history, while the stock is also 30 to 50% cheaper than the sector, despite, again, them being a market leader. And for as bad as that debt is, I do at least think that the dividend is sustainable while also being able for them to pay back debt. For example, we just saw in their most recent earnings that through the first half of this year, capital expenditures fell by a couple $billions thanks to not having to invest so heavily into 5G anymore, while operating cash flow came in at $16.6 billion, enough to cover the $8.1 billion of capex, leaving behind $8.5 billion in free cash flow, which was also up $500 million, and that easily covers the $5.6 billion in dividends, which altogether leaves about $3 billion left over for paying down debt. So at the moment, at least, it does look sustainable to me to a certain degree. And the hope is that, interest rates start coming down at some point. They have to, right? Putting even less pressure on them going forward. And that makes the dividend a bit safer longer term. At least that's the hope. Of course, if things get worse and the dividend has to get cut, yeah, we'd probably get screwed as investors. So there is significant risk from that point of view. But I just think at these levels, it's kind of worth the trade-off. So I kind of see it as like a medium risk at the moment. But finally, that'll leave us now with stock number 3. Oh boy, we got a special one for this one. This is going to be the highest risk of the bunch. And this is, again, another one that is trading near a decade low, but I'm actually going to go with a stock here that just recently crashed into the ground this past week coming off of horrible earnings. But hey, if you want an extremely low price with turnaround potential, well, that means you're going to have to take on some heavy damage here and some high risk. There's no easy way around that. So my pick is going to be for that category, the chips giant Intel, ticker symbol INTC, who I can really summarize their entire story and the turnaround potential too, and kind of the investment thesis behind it with a couple of points. Now, first of all, we all know that processing chips will only become more important over time globally as the world becomes more digital and technologically advanced. So the case for really any chip stock, I think, starts right there, in that there is plenty of long-term potential for anyone in that space. However, what used to be a very dominant player in Intel has now really ceded tremendous ground to rivals like NVIDIA and AMD, who went all in on discrete GPUs that have skyrocketed in popularity and demand thanks to how useful they are, especially in areas of artificial intelligence and cloud computing, which of course have been on the rise and popularity has been soaring. To which Intel instead focused primarily on CPUs and APUs that haven't really proven themselves to be nearly as capable for those specific tasks. And because of that, plus a number of other blunders and screw-ups from management, along with them also being their own manufacturer, and that led to countless product mistakes and delays, well, the three stocks have performed very differently over the past decade. In fact, you look back a decade ago, and Intel was actually much larger than both of those two rivals combined, with a market cap that was more than 12 times larger. So you take AMD and NVIDIA, combine them as one company, and you make 12 of those, and it would still have not been worth as much as what Intel was at that time. That's how important and dominant Intel used to be. And yet you look at the way their stocks have performed, and you see a complete reversal now. Over the past 10 years, AMD stock has skyrocketed by over 3,000%. NVIDIA has also skyrocketed, but by over 21,000%. Absolutely insane. And yet Intel, well, it's actually down about 40% during that time, leaving it now at literally the lowest price of the past decade, while also losing over 67% of its entire value from the top, after falling by over 30% just this past week alone on horrible earnings. Which, by the way, those earnings showed that the issues are continuing to linger on even to this day, and Intel continues to struggle in adapting really to this evolving market. Now, I will go deeper into those earnings in tomorrow's video, because I'll be doing my weekly recap for several earnings reports of the week. So if you want to learn more about it, look out for that video tomorrow. But for now, the point is that this once giant and very dominant company has now lost ground, with even AMD stealing lots of market share from their bread and butter CPU business too. And yet, I still think that they can turn things around, and I really have like three specific reasons for why I feel that way. Number one, they're still a market leader of CPUs and APUs, which are not going away and will actually continue to grow in demand with the rise of new AI-featured computers and laptops, especially going into the second half of this year, people returning back to school and all that kind of stuff. So I think you could have a recovery start to take place there, start to show up more prominently at that time. But what is much more important than that is the fact that Intel is now finally fighting back against AMD and NVIDIA on AI, with not just their high-power CPUs, but also by now making discrete GPUs too, as well as, most importantly, a new type of chip called an AI accelerator. This is a specifically designed chip for AI workloads, and it's already showing a ton of promise on not just performance, but even price, which is important for competing against NVIDIA, given the stronghold that they have over that market. If you want to be able to break in and start to steal some market share, well, you're going to have to at least compete with them on price, because you may not be able to beat them on performance. But, you know, even there, I mean, this report here coming from Forbes says Intel's Gaudi 3 is reportedly showing a 50% and 40% improvement on inference and power efficiency over NVIDIA's H100 AI processors, which have been very popular, but it's doing it at a fraction of the cost. And guys, that's a very big deal. They're aiming to ramp up availability for Gaudi 3 here in the third quarter, moving over to the second half of this year, going into the future. If this starts to perform well and they can build off of just a little bit of momentum there, could really help them turn things around for Intel. And look, they don't have to overtake Nvidia. I don't think they'll ever even get close at this point, but they just need to start competing. You just got to start putting stuff out there that can actually compete, whatever it is. Compete a little bit on price, compete a little bit on performance, whatever it is, give companies an alternative, and that can really start to help you longer term. Reason number two, though, chip production is outsourced by both AMD and Nvidia overseas. And while that has had huge advantages over the past decade, I believe that the future will, it might play out a little differently, with America and other Western countries wanting more manufacturing independence from Asia, which bodes extremely well for Intel, who not only builds chips in America, but even in Europe too. And they've been expanding a little bit too. And with America providing giant subsidies and tax incentives to the tune of tens of billions of dollars, probably could end up being hundreds long term. I mean, it's massive, like the amount that they're going to spend on this. And when you also calculate in the tax incentives, it's a giant amount of money. Well, I think Intel stands to benefit greatly from that financial support and rising demand. It will take years to materialize. You're not going to see it right away. And I think that's why the stock is still getting punished today, because it's not really being factored in. But longer term, it could help them rebound a little. And lastly, my last point, I just think Intel stock is so dirt cheap at this point. I mean, I feel like I might as well just take the gamble on it, with the market cap only being worth less than 100 billion today. That's less than half that of AMD's, while Nvidia is north of $2.5 trillion. And meanwhile, Intel's PEG ratio is also 70% lower than the sector, despite, again, still being a leader in certain cases. So I just think it's worth the bet at that price, even if it is high risk. But I would only make treat it as a small risky bet, but I like it for that. And all three stocks that I talked about today, I'm buying all of them at these levels because I just think they look attractive here. But again, you have to consider the risk. Anyway, thanks again for stopping by, my friends. I hope you enjoyed the video. Let me know what you think about these stocks down below, or any other stocks that you're buying out there, and maybe I'll make a video on some of them in the future too. But thanks again for your support, my friends. I hope you're all doing well. If you want to go above and beyond, you can support me on Patreon. Gets you access to our Discord, our community portfolio. It's a lot of fun. But just for viewing the videos means a lot to me too, and I appreciate it. I'll catch you guys next time. Take care, my friends. All right, bye-bye.